Well, greetings and welcome to the first investment strategy brief video of 2021. What I want to do this month is to focus just briefly on our Outlook 2021 report, reflections, and a way forward. You know, when we look back at all that went on in 2020, and we'll talk about it, it's really a good time to reflect. And as we look forward, you know, we see a pathway, we see a way forward. So let me just explain the report a little bit in terms of what we put together. As we do each year, and we usually publish it the first week in January, it's a series of articles. We look back to 2020, we look forward into 2021, we talk about asset allocation, a few topical articles this year about the election, about coronavirus, the pandemic, and how it's impacting our investment themes, etc. So again, sort of a comprehensive report we get out in both a written and a video form, and then also actually a client webinar. There's a replay for that. So let's just talk about a few of the articles just super briefly. The first is the idea that the pandemic and coronavirus and the challenges have impacted our major investment themes. So the idea of productive competition, we actually as a world were competing against the virus, lots of innovation to do that. That was influenced by the fourth industrial revolution. Think of it as technology basically driving, accelerating change in areas this last year, like medical research, the idea of kind of getting a virus put together, all that. We saw some effects on shifting demographics. We saw some effects on geopolitics and the tensions there. And then we created a new theme, actually, called Managing Through Economic Recovery. And we'll be talking about that a little bit through this presentation. Now, a second article we covered was really focused in on geopolitics and really got into a number of them, but four that I'll mention. One is U.S.-China competition. Kind of just the snapshot at this point in time is that we're competing hard against China. It was an anchor to the 2020 outlook, actually, a decade of productive competition. And we don't see that changing. Obviously, the tensions of the pandemic kind of added to that a little bit. And then as we see a new administration coming in, Joe Biden coming in as president, we think he'll continue to be tough on China. And speaking of being tough, I think he'll also be tough on Russia. Back in the day when he was vice president, he was known to be kind of tough on Russia. We think that mindset will continue. We do see our relationship with Europe improving a little bit. And then a nice thing to do, we don't often do with this risk dashboard, is to actually take Brexit off the list as seeing it resolved now that a UK-EU comprehensive trade agreement has been put in place. Another article we put out there, a brief sort of snapshot, was this idea of how to handle uncertainty and using behavioral finance to do that. Basically, we walk through a three-step process. Learn about common biases, take our financial ID questionnaire to know yourself, and then with all that, armed with all that information, take a step back with your financial advisor and potentially refine your investment plan. Another thing, speaking of investment plan, that we get into is the key tenets from our perspective of a successful investment strategy. The first is to define goals and objectives. The second is to be diversified both across and within asset classes. Then align implementation, meaning select products that line up with your preferences, your goals, objectives, etc. And then get together with your financial advisor periodically, maybe every year, every couple of years, review how things are going and refine your strategy accordingly. So again, think of these as a series of articles that you can dig into in the report. Now, an anchor to the report, of course, is our outlook itself. And when we look forward into 2021, like we often do, we actually modeled three scenarios: a base case, a bull case, and a bear case. Our base case, which we assigned sort of informally a 70% probability to, is positive in that the vaccination program and campaign will be successful here in the U.S. and at least eventually abroad. We think the federal government, including the incoming administration, will remain supportive, focused on supporting economic recovery. And then, as mentioned, we see geopolitical tensions remaining, but maybe lessening some in 2021. Now, our bull case really looks to the idea that the path to herd immunity goes even faster, and consumers and businesses get more confident quickly. The bear case, on the other hand, really is driven by a couple possibilities. One is that the vaccination program actually takes a bit longer. But then the other one that we've sort of been thinking about is the idea that the economy heats up so quickly that inflation starts to move up and kind of out of control. And again, those two tail cases, bull and bear, we see as roughly 15% chance each of happening. Now, in terms of our outlook, though, in terms of the numbers, we sort of model three categories, sort of macro views, equity views, and bond views. In the macro space, we see inflation rising, maybe settling in the second half of the year a little above the 2% target for the Fed or from the Fed, but maybe averaging for the year around the Fed's target of 2%. We see GDP well above long-term trend growth at 3.75% to 4.25%, somewhere in that range. We see volatility maybe falling off a little bit from what we experienced last year, which was pretty volatile, and then the dollar weakening. Our equity complex we view as positive looking forward into the year. I like to think of it as just a little bit ahead, a little bit beyond our long-term average expectations. And you'll see a pattern, small caps doing a little better than large caps, non-US stocks, both developed and emerging, doing better than US stocks. And we'll talk about that again in a couple of minutes. And then finally, fixed income. We see the Fed not moving in terms of policy. We see the 10-year rate moving a little higher. And then credit spreads, that little extra you get paid to take on non-treasury bond risk, they had widened out, and we'll look at some data here in a second, and they've narrowed. Maybe they'll widen a little bit from the narrow place that they are now, but not a lot. So other things that we covered in the report, of course, was the 2020 election and a look forward into 2021. Obviously, it's basically been a blue wave, but maybe a smaller wave than some might have expected. So Joe Biden took the presidency. We see the House going to the Democrats, but with fewer seats. And then we saw the Senate win both of the Georgia runoffs to take the Senate to 50-50. What we see is really, in some ways, balance. It's going to still be tough to get a lot of sweeping change done, but the Democrats definitely have some control, and they'll take advantage of that in terms of implementing the platform that they campaigned on. Now, a few other kind of key points. We like to look back at FDR and the tradition that he started with a focus on the first 100 days. Think of it as a honeymoon period where the president comes in with some political capital and will use that sort of 100-day effort to get some key things done. We think soon-to-be President Biden will focus on the pandemic, vaccinations, and economic support. In fact, the plan that he's going to put forward includes already announced a $1.9 trillion economic relief package, so checks to $1,400 in individuals' hands, raising up the minimum wage to $15 an hour. And then other things that will probably focus on things like executive actions to reopen schools and businesses, on the international front, rejoining the Paris Climate Change Agreement and the World Health Organization, and probably reversing President Trump's travel ban. So there'll be a lot of action, but again, likely not sweeping change. Now, turning to the pandemic, introducing a couple of new slides because we're in a new era. Vaccines are being administered. And if you look at this chart on the left here on this next page, this is basically estimated daily infections. And you can see sort of three humps. We're in this big climb up right now with the colder weather and maybe a slightly more tough virus in terms of spreading around. And then all of a sudden you see the line just drop down. That's basically the model that we're pulling here that is showing the effect of the vaccines. So the spirit of it is, as we see the vaccines administered in the first quarter and into the second quarter, then the infections are going to go down as a result of that, which is really great news. And you can see on the right here, this is just the beginnings of the kind of monitoring we'll see for how many people are getting vaccinated on a daily basis and how that's accumulating. I like this chart on this next page, which is interesting because that line represents herd immunity. Think of it as being the combination of how many people have been vaccinated versus how many people have been infected. And so you think of it as the two combined. When you get to about 60 or 70%, they're debating what that number is going to be, you're at herd immunity. So we're going to be watching, and each of these dots is a state here in the U.S., and then that sort of center dot is the country overall. But think of it as a state monitoring the total amount infected plus the total amount vaccinated. When that number gets up towards 60%, they're getting towards herd immunity, which is the goal here, obviously, as it relates to sort of lessening the impact of this pandemic. Now, this is all possible because of medical innovation. I was talking to the team this week, and I look at this chart, and when we first started it, it was a simple idea. Let's put on a page some of the things we know happening around medical innovation. And as the innovation happened, the page kept getting more and more and more dense. And literally every time we do it, we have to go through and cut some things and make some things a little bit more abbreviated to add the new innovation. The punchline here for sure is the idea of 2 vaccines here in the US, probably more to come, and getting produced and getting distributed. So we're obviously very focused on that and positive on basically the medical innovation that's happened. Now let's turn beyond that outlook then. That's all sort of a capturing of the outlook and what we covered in that report. I want to get back to some of the more normal things. This macro environment chart, 3 columns, just kind of covers a variety of things that we are looking at, and many of them we've already talked about. So I always like to focus, for example, on the headwinds and tailwinds. And here, without question, the headwinds really relate to the pandemic and the tailwinds really relate to the vaccines. So it's really this battle we've been going through with the pandemic and what is the course to get to herd immunity and beyond it. Now, obviously, I mentioned the idea of Biden including a now announced $1.9 trillion package. This is really against a lot of action that took place in 2020. So this next exhibit just captures an update to the unprecedented policy response. And I will say one of the things that we're starting to talk about and hear about is, okay, this is necessary. We want to help people that are in trouble and sort of, make sure we're filling gaps, if you will, in terms of the economy. But we have to start talking about and thinking about how all this is ultimately going to get paid for. So expect that to be a thread and a theme, if you will, that sort of unfolds through the year. In any event, we'll see. I think as it relates to $1.9 trillion, with the sort of balance in Congress, I think it'll probably end up being a classic negotiation between the administration and Republicans in Congress and Democrats. And we'll probably see that number fall down to, there's talk of it being even below $1 trillion. So we'll see how that goes. Now, switching to some of the charts that we like to look at, remember that we have these exhibits that show long-term trends that trend over the last year, and then we color code the most recent print, if you will, green being good, red being bad, and then scaled colors in between. What I would say about the consumers, you can think of it as sort of 3 buckets of information. And the first is really their activity. So you're seeing spending, you're seeing retail sales, and I would say generally the consumer is kind of back in terms of spending money to a very good degree. And so that's, in terms of the economy, that's good. A second bucket is sentiment and confidence. It happens to be this month that we have that consumer confidence exhibit on the bottom left of this page. Bottom line is it's not back to where it was pre-pandemic. It's close to long-term average, but basically nowhere near the level of confidence we had right before the pandemic. Anyway, the third category is employment, and essentially things were improving until the virus started to spread. We saw some rollback in some of the reopenings and such, and essentially unemployment, the rate actually laid flat month over month, and so you can see the 6.7% as the latest print, and obviously improving, get everybody back to work is super important. Housing, we've talked about month to month, basically a very bright spot, lots of green on this page. Volatile data points, but on average, we're just seeing lots and lots of positive numbers on housing. And then on the business side, same kind of thing. It's a little bit more mixed. All the sentiment-based things, in terms of looking forward in particular, the Purchasing Managers Indices, PMIs, when we see those above 50, that means the business leaders and managers think that their business, and therefore it sort of projects that the economy is growing. So we see both in manufacturing and in services numbers well above 50, and in fact back to the levels before the pandemic. So that's a positive. In any event, a variety of data, on average, things looking pretty positive. And it's all data that we'll continue to watch. I've mentioned inflation. I've mentioned our forecast that we think inflation is going to rise some. But right now, it's well below the Fed's 2% target. This happens to be 7 measures that we track. All of them, you can see, sort of hovering between about one as low as 0.5%, but basically between 1 and 1.5%. We think all of these numbers are probably rising in the coming year. Now, a final thing in terms of monitoring is what we call the coronavirus dashboard. And here again, we just picked a bunch of data that we wanted to track. Some of it we've talked about, like PMIs, and essentially looking to see it from a macro and sort of survey and market data, how things are going. And you can see anytime you see a green arrow, that means the data is recovered. So a lot of them have recovered since the pandemic started. and others have not. So obviously one is a good example is GDP. This is really capturing the 2020 GDP. And what we all know is that we're going to end up seeing a contraction for the year. The good news is it's not as bad as what might have happened based on what was thought, let's say, in middle of 2020. So a better than expected outcome, but still negative. On this next page, just some market-related data and then the COVID data itself. And again, we'll start to fold in much more intensely as it becomes available, this idea of the path and march to herd immunity. Finally, the consumer, we've talked about this, but just to wrap it from this perspective, retail sales up, unemployment sort of flat into December, end of December. So again, we're going to want to see some improvement there. Consumer confidence, okay, but not as good as before the pandemic. And then jobless claims have actually bumped up a little bit. So again, that idea of the virus spreading, the idea of rollbacks and reopenings, maybe some businesses, again, laying some people off, we're seeing jobless claims climb just a little bit. This all rolls up to the idea of the economy and the forecast for the economy. This is a very busy chart, but I draw your attention mostly to the top line, the consensus view. We're sort of tracking what happened through the first 3 quarters of 2020, what the consensus expectation is for the fourth quarter, and then looking into this year, basically. What you see is an expectation, rolling it all up, of being down 3.5% for 2020 and up 4.1% on a consensus basis for 2021. So again, well below in a contraction, below long-term average growth, and then a rebound, if you will, to make up for some of those losses. Now let's turn to the markets, starting with rates. I always like to focus first on the Fed. I mentioned before, we don't see the Fed changing its policy. That blue line in the upper left of this page basically is the Fed funds rate. It's going to stay low for a good long time until the Fed really sees the economy recovered and inflation start to really rear its head well above its target. We've seen, as a result of this positive environment, interest rates starting to rise and the yield curve starting to steepen, and that's good. Again, it's something we've expected. And then I mentioned the idea of spreads. You can see the 2 charts on the bottom of the page here. That widening out corresponded to the bear market we're going to look at in just a second. And then as the market improved and risk kind of came down, if you will, here in the U.S., the spreads came back in. So on the equity front, we've been using this chart for a couple of years to first explain the 2019 patterns. It was so innocent, but it seemed so intense at the time. U.S.-China trade and Fed policy were the drivers in 2019. 2020, of course, it was all about the pandemic, and you can see that second column, big, huge declines in the market, big bear market, and then big recovery. We sort of cut it at early September because the market actually rolled over after that. And of course, as you can see by this chart, then recovered. Net, when we look at the full year, it's a very positive year with the S&P 500 up over 18%. FANG stocks, kind of think of it as those big techs, up over 100. And boy, who would have thought when we were at those lows of March 23rd that that's where we would end the year. So really it was a very, very strong recovery. In terms of earnings, this chart just shows that there's been an expectation of earnings recovery, and that's still the case, that we see earnings growth forecasted for first quarter, and then even more earnings growth forecasted for second quarter, kind of making up for some of the declines last year. So something we keep tracking because it's so important to equity valuations. Now, what does all this mean in terms of our dynamic leanings? Well, remember that we like to think of our investment guidance as being delivered against a strategic framework. The idea being, invested across multiple asset classes and within asset classes across multiple different categories, so diversified across and within asset classes. And sometimes clients and advisors will take that strategic guidance. You can think of it maybe based on risk profile as a set allocation, maybe rebalance back to it from time to time. But sometimes people are interested in our shorter term, sort of think shorter to medium term leanings against those strategic mixes. And so what I want to highlight is a few changes that we've made, some that have been in place for a little while, but some additional changes. So for example, we've just recently gone overweight non-US stocks. So remember that forecast I showed that we think non-US will do a little better than US. We want to take advantage of that by slightly overweighting non-US stocks. Now, within the U.S. market, we've gone overweight small cap, which has been a beneficial leaning. here in early 2021. And we've also gone overweight large cap value, which also has been a beneficial trade, if you will. On the fixed income side, because of the observations about inflation, we're going to go modestly overweight TIPS, so Treasury inflation protection securities. And for those that will use active management, probably in the form of mutual funds, we think it's a decent time to consider a modest overweight to high yield, where we think there's going to be a little bit better return, but also really good opportunity given the intensity of that part of the market for talented managers of mutual funds, et cetera, to find value. So again, a modest overweight to high yield. So listen, that's it for this month. I just will close, as I like to do, with an invitation. On this last page, basically, you have links to all of our work. We certainly welcome your review of it. Included on here, by the way, is that 2021 Outlook report and the video. So we welcome your review of any and all this work, and we look forward to speaking with you next month. Thank you.